of the common things that I get questions about every day, and one of the things I read a lot in the media, is talking about millennials. Millennials are missing out on the markets. They just need to invest, and they're going to be great over time. And of course, the question is that really the case? Let's start with one of the basic examples that's often given. I'm going to invest $3,000 into the market. And every year, I'm going to contribute $3,000 to the market. And I'm going to get a 10% annual growth rate because that's what the markets have returned over the last 120 years. So let's take a look at this chart here, which shows you that idea. $3,000 invested, growing at 10% every year. This is what it looks like. Pretty staggering, to say the least. But is that really what's going to happen to money? One of the things that is often never discussed is the starting level of valuations when you start making investments. One of the big issues, of course, is that the more that you pay for an investment, the lower the rate of return is over time. Mathematically, we can prove this, but I can show you graphically as well. The starting level of valuations is crucially important to the long-term outcome of your investing. I want to show you this. Let's assume that I invest $1,000 into the market on a total return basis, that is both capital appreciation and dividends included, and the 4 times in history when valuations exceeded 20 times earnings. Well, those 4 periods look like this: 1900, 1929, 1962, and 1993. All 4 of those periods were periods where starting valuations were 20 times earnings. But let me show you something. Look how long over a period of time before you actually started making real returns on your money. Yes, markets went up and down, but valuations of your portfolio didn't grow much. It was until that valuations had corrected at the end of the period, the last 10 years of your investment savings horizon, that you actually started making money in your portfolio. Let's flip the coin around. Let's talk about what happens when you start investing when valuations are around 10 times earnings, or what we would call historically cheap valuation levels. That's this next chart. Again, we take a look at the 4 times in history where valuations started at 10 times earnings: 1918, 1932, 1942, and 1980. And you'll notice that you started making money and portfolios grew well over time because of the lower levels of valuations. But I can show you this a little bit more efficiently by combining each of these 4 periods together into one chart. This next chart shows you exactly that. The same idea of $1,000 on a total return investment made in both periods where earnings were 20 times earnings at the beginning of the period, as well as 10 times earnings. And what you can see is at the end of the 30-year period, by starting with lower valuations, your end result was much greater than it was at the beginning of the period. But what does this have to do with you and your long-term investment horizon? Everything. Because what you're being told is just put your money into the markets and over the long term, you're going to make money. And that's true. But the difference is, as always, whether or not that you reach your investment goal. Let me show you this on this next chart. What this next chart shows you is the importance of understanding the difference between compound returns and real annual rates of return based on market valuations. What you're told by the media and what this chart shows you, if I just invest $3,000 every single year and compound it at 10%, it looks like this. And of course, what you see here is this great return and the promise of long-term prosperity. That's not how money really works. And that's not how markets really work either. Let's take a look as if we invested our money at 10 times earnings when valuations were historically cheap, again using total real returns and adding $3,000 every year on a dollar cost average basis. Our returns look like this. Not too bad. It's kind of close to that 10% annual return number, but there is a shortfall between that. But if we start to invest when valuations are at 20 times earnings, the difference is pretty enormous. Looks like this. Again, the shortfall makes a huge difference in your long-term returns. And let me show you the importance of what this looks like. This next chart shows you the differential between investing at 10 times earnings and 20 times earnings at the beginning of the investment period and the shortfall that it turns out to be. At 10 times earnings, your shortfall is not terrific, but it does keep you from retiring on time. At 20 times earnings as your beginning valuation, the shortfall is vastly different. The important point of this conversation is simply this. There's a vast difference between what a lot of the media tells you about how money works, talking about annual compounded rate of returns, etc., and how money really works based on valuations and actual market returns over time. The important thing to remember as a young investor, or really as any investor, is that the valuation level when you start your investment time horizon is crucially important to your long-term outcome. More importantly, the difference between whether or not you're able to successfully retire or not. So let me give you 7 steps to, well, investment success to take a look at. With the market currently trading at the 3rd highest valuation level in history, only surpassed by the peaks in 1929 and 1999, you can only surmise what the outcome for a young saver will likely be. What the analysis reveals is the important points that young investors should consider given current valuation levels and the reality of investing over the long term. First, expectations for future returns should be downwardly adjusted. The potential for front-loaded returns going forward are highly unlikely. Controlling investment behaviors and emotions that detract from portfolio returns is critical. Future inflation expectations must be carefully considered. Understanding the risk and controlling drawdowns in portfolios during market declines is crucial to achieving long-term investment goals. Save money regularly and invest when rewards outweigh the risk. Lastly, expectations for compounded and annual rates of return should not be dismissed. One important note here is that throughout history, at the peak of every major bull market cycle, whether it was 1929, 1999, or even 2007, there was one type of investment platform that really stood out above all others. Currently, that's this idea of passive indexing and robo-advising. It's the latest innovation in markets, and the problem is that it doesn't take into account the very things that drive long-term investment returns. So importantly, when considering any type of investment structure, is to go back to understanding that you have to control the volatility of portfolios and the risk to your money. Importantly, investing isn't a competition. There are no rewards for beating the market, but there are severe and lasting consequences for chasing markets where others fear to tread. So just remember, you're fine as long as there's a greater fool to sell to. Just make sure that fool isn't you. For more videos on these type of topics as well as more information, be sure and go by our website at realinvestmentadvice.com.